Financial restructuring and turnaround strategies are critical tools in the arsenal of corporate leaders facing challenging times. When a company finds itself in financial distress, these strategies can mean the difference between recovery and failure. At the heart of financial restructuring is the process of reorganizing a company's financial obligations to improve its financial health. This often involves renegotiating debt terms, reducing interest rates, or extending repayment periods. In some cases, it may even mean converting debt to equity, giving creditors a stake in the company's future success. Turnaround strategies, on the other hand, focus on operational changes to reverse a company's declining performance. These can include cost-cutting measures, divesting unprofitable business units, or refocusing on core competencies. The goal is to stop the bleeding and return the company to profitability. One key aspect of successful restructuring is timing. Companies that act early before a crisis becomes severe often have more options and a better chance of success. Proactive restructuring can involve renegotiating contracts with suppliers, streamlining operations, or seeking new sources of capital before the situation becomes dire. Another crucial element is leadership. Turnarounds often require tough decisions and a clear vision for the future. Strong leadership can rally employees, reassure stakeholders, and guide the company through turbulent times. Legal and regulatory considerations. Navigating the legal and regulatory landscape is a crucial aspect of corporate restructuring. The process is often complex, involving a web of laws and regulations that can vary significantly depending on the jurisdiction and the nature of the restructuring. One of the primary legal considerations in restructuring is bankruptcy law. In many cases, companies undergoing restructuring may need to file for bankruptcy protection to gain breathing room from creditors and negotiate new terms. Understanding the different types of bankruptcy filings, such as Chapter 11 in the United States, is crucial for companies considering this option. Securities laws impact restructuring involving ownership changes or new securities issuance. Compliance with disclosure requirements and regulations is essential to avoid legal issues. Labor laws are vital when restructuring involves workforce changes. Companies must navigate these cautiously to avoid legal issues. Antitrust laws may apply to restructuring involving mergers or acquisitions. Companies must ensure their plans don't lead to anti-competitive situations that could invite regulatory scrutiny. Tax laws are important in restructuring, as they can influence decisions and have significant implications. Stakeholder communication during restructuring. Effective communication is paramount during corporate restructuring. The process can be unsettling for various stakeholders, including employees, customers, suppliers, and investors. Clear, transparent, and timely communication can help manage expectations, maintain trust, and ensure smoother execution of restructuring plans. For employees, restructuring often brings uncertainty and fear. Open and honest communication about the company's situation, the need for changes, and the potential impact on jobs is crucial. While difficult conversations may be necessary, transparency can help maintain morale and retain key talent. Customers need reassurance that the company will continue to meet their needs. Communication should focus on the company's commitment to quality and service, even as it undergoes changes. It's important to address any concerns about product availability or service continuity. Suppliers are another critical group. They may be worried about payment for goods or services, or about the future of their relationship with the company. Clear communication about the company's plans and ability to meet its obligations can help maintain these crucial business relationships. Investors and shareholders require detailed information about the restructuring plan, its expected impact on the company's financial position, and the timeline for implementation. Regular updates on progress and any changes to the plan are essential to maintain investor confidence. Creditors, including banks and bondholders, are key stakeholders in many restructuring scenarios. They need to understand how the restructuring will affect their claims and what steps the company is taking to ensure it can meet its obligations. The role of distressed debt and bankruptcy. Distressed debt and bankruptcy play significant roles in many corporate restructuring scenarios. Understanding these concepts is crucial for companies navigating financial difficulties and for investors looking for opportunities in troubled companies. Distressed debt refers to the bonds of companies that are either in bankruptcy or at high risk of bankruptcy. These bonds trade at a substantial discount to their face value due to the increased risk of default. For the issuing company, the existence of distressed debt can be a sign of serious financial trouble and often precipitates restructuring efforts. However, distressed debt also presents opportunities for certain types of investors. Distressed debt investors buy these bonds at a discount, hoping to profit if the company successfully restructures or if the debt is converted to equity in a bankruptcy proceeding. Bankruptcy, while often seen as a last resort, can be a powerful tool in corporate restructuring. In many jurisdictions, bankruptcy laws are designed not just to liquidate failed companies, but to give struggling companies a chance to reorganize and emerge stronger. During bankruptcy, a company may be able to reject unfavorable contracts, restructure its debt, and make other changes that would be difficult outside of bankruptcy. The process also provides a structured framework for negotiating with creditors and other stakeholders. However, bankruptcy also comes with significant costs and risks. It can damage a company's reputation, make it harder to obtain credit in the future, and result in significant job losses. The process is also expensive, with high legal and administrative costs. Success stories of corporate turnarounds. Corporate history is replete with examples of successful turnarounds, where companies on the brink of failure manage to reinvent themselves and return to profitability. These success stories offer valuable lessons for other companies facing similar challenges. One notable example is IBM's turnaround in the 1990s. Once a dominant force in the computer industry, IBM found itself struggling in the early 1990s as the PC revolution disrupted its business model. Under the leadership of Lou Gerstner, IBM shifted its focus from hardware to services and software, transforming itself into a global technology services company. This strategic pivot, along with significant cost-cutting measures, allowed IBM to return to profitability and remain a major player in the tech industry. Another inspiring turnaround story is that of Apple Inc. In the late 1990s, Apple was on the verge of bankruptcy, with its products losing market share and its finances in disarray. The return of Steve Jobs as CEO marked the beginning of a remarkable turnaround. Jobs refocused the company on a smaller product line, introduced innovative new products like the iMac and iPod, and later revolutionized the mobile industry with the iPhone. Today, Apple is one of the most valuable companies in the world. In the automotive industry, Nissan's turnaround under Carlos Ghosn in the early 2000s is often cited as a textbook example of successful restructuring. Ghosn implemented aggressive cost-cutting measures, closed unprofitable factories, and formed strategic alliances to turn the struggling Japanese automaker into a profitable global player. These success stories highlight several common themes in successful turnarounds. What we can learn is that they require cultural shifts towards innovation, customer focus, and accountability. Learning from successes and failures guides organizations facing similar challenges. Embracing continuous improvement and adaptability helps companies overcome obstacles and thrive.